Rick, thanks for doing this. I appreciate it, and it's great to meet you.
My pleasure. Thank you for the opportunity to visit with you and your audience.
So it's the world we're in today. The carousel is just getting faster and faster and faster. So I want to start off and ask you, what is it that what is at the top of your mind today as we sit here on Tuesday, March? What is today? The 11th.
Well, I have two comments about that. I've been 72 years on Earth, so I've been through other interesting times. And as I look back over 50 years as an active investor, I remember that in good times and bad, my biggest opportunity and my biggest risks are always myself, my reaction to events. I like to tell audience that the biggest risk they face is to the left of their right ear and to the right of their left ear. And that just because all of those about you are losing their heads, there's no reason that you need to lose your head. I think it's important to note that. If you ask me what my biggest fear was, my biggest fear is uh, likely credit contagion in the junk bond market, in the high yield corporate market. The structure of that market, I have to say, scares the hell out of me. The proliferation of yield oriented ETFs, hugely liquid and hugely large, but the underlying assets, the junk bonds that they own, aren't liquid. If concern about credit were to spread to Main Street, Ma's and Pa's taking credit risk they didn't understand to eke out 150 basis points better yield, and they began to sell those junk bond ETFs, I think that could be catastrophic because the top codes, the ETFs are so liquid and the assets they own are so illiquid that as ETF holders liquidated, the managers wouldn't be able to sell the underlying assets fast enough to fund redemptions. When I was a young man in the high yield credit markets, uh, we had a we had a moniker for illiquid bonds. We called them owl bonds. An owl bond is when you call your broker and ask your broker to sell the bond. They respond, to who? To who? And if there was one thing out there that really scares me in the market, it's those high yield ETFs. If we had a retail concern about credit quality in the United States, that would yield 2008 on steroids. I'm not saying, by the way, it's going to happen, but you asked me the question, so I answered it as best I could.
What does your sense tell you, though, based on what you just described, that it may or may not occur?
I have no idea. I really, truly don't. Um, and I don't spend an awful lot of time pondering stuff I don't have the ability to understand. Uh, I found that macro gets views and macro is interesting and micro makes money. So I described myself before the call as more of a credit analyst than an economist. And I don't spend an awful lot of time thinking about it. What I do try to do is prepare my own portfolio for most eventualities. An example, I believe current interest rates are lower than the real deterioration of the US dollar, which is to say, I think the CPI is a CPI. And I think that holding cash reduces my wealth. But I hold cash anyway because I want liquidity. I want to make sure that if we have a liquidity driven event, that I have the cash and the courage to take advantage of it, not being taken advantage of by it. People say that gold is a non-performing asset. Buffett calls it a pet rock because it pays no yield. But I own it anyway because it allows me to sleep nights and stay calm. And I don't own myself any financial assets in companies that I don't understand. I confine my own investments to conventional financial services, which is to say banks, asset managers, wealth managers, and insurance companies, and natural resources companies, because I understand them. I don't own technology companies. I don't own consumer durables companies. I don't own crypto. I don't own anything I can't understand. That's because I've learned personally over 50 years that my biggest investment risks center around myself, not around world events. So I try to structure my portfolio in a way that almost irrespective of what happens to the world around me, notice I said almost, almost irrespective of what happens to the world around me, I muddle through as best I can.
Had you ever, kind of dipped your toe in the water and, looked at companies that you didn't understand and it backfired on you and that's what
Yeah,
changed?
yeah, but not very much. I mean, when I go back to in my 30s, I thought that my success in natural resource investing meant that I was a good investor rather than a good natural resource investor. And I took some risks in industries I don't understand. I didn't understand, and it didn't work out very well for me. Also, however, in my 30s, I did some deep value investments, which is to say, I bought fairly small companies that were selling at discounts to net cash, buying cash flow businesses at a discount to working capital, what Ben Graham called free bonds. And when I imposed that discipline on me, even though I didn't understand the companies very much, I did fairly well, albeit those were extremely boring businesses. What I have never done, or at least I haven't done for 45 years, is invested in the flavor of the month because it was going up, because the narrative was on the front page of Fortune or Forbes or the Wall Street Journal. I'm really, truly, personally immune to fear of missing out. And the consequence of that is that I've missed out on a lot of mistakes in the last 4 decades.
That's a great saying right there. That's a
You,
T-shirt idea right there, Rick. That's a coffee mug idea.
you say enough, and sometimes you say something smart.
Well, and so in all your years of experience, as close as 2008, are you seeing any parallels right now in terms of the level of fear or anything in common with it? Because I think of something that sticks out in my mind. Let me share this with you and tell me if you agree or disagree. Because you look back at 2008, where you saw the financial sector melting down, right? And I was working in retail banking. I hate to retell the story for my audience, but I think it's appropriate because you don't know it. I was working in retail banking at that time, and I live in Phoenix. So I saw people's property. One of the parts of my job was doing a lot of home equity lines, stated income, up to 100% loan to value, and everybody was having a party out here, right? Everybody owned 4 houses and a condo. That's why I laugh at the movie The Big Short, because Steve Carell was with that stripper, and she's like, I have 5 houses and a condo. That was like the norm out here. But everybody was making money, right? From the broker to the underwriter to the appraiser, and all of a sudden you saw things like people's property values drop, their bank accounts would drop. People would come into the bank. I'll never forget this. They would come in and they would take out large amounts of cash and they would want to put it in their safety deposit box. I would look at them and be like, you realize if the bank is not open tomorrow, you're not going to be able to get into this box to get this money. But people weren't thinking clearly. But I also think at that time, if we had social media and phones the way they are today, back then, I think that problem would have been much, much worse. Do you think that has something to do with being able to, like, all the panic and fear that we're, it could overstimulate right now?
I don't know the answer to that. I mean, I understand what you're talking about the velocity of emotion in social media, the proliferation of experts who don't know very much about anything. Where that leads, I really, really, really can't tell you. I don't know. My own story around 2008 is instructive, I think. I have invested in conventional real estate on and off for a very long time with other people who understood it better than me and done fairly well. Although I exited most of my uh, developed real estate investments in 2022 when I began to be afraid that interest rates would rise. But that's a different story. I remember in late 2006 driving up the 405 freeway in Los Angeles and seeing a billboard on the right-hand side of the freeway going northbound. And it said, borrow 125% of the value of your home. Bad credit, okay. And I was thinking, although I didn't know much about real estate, that I've invested in banks for years and years and years. I'm a lender. And I was thinking, boy, I don't think that'll work out too well for the lender. but I didn't think anything about it. It didn't set off these sort of warning lights to me because I wasn't involved in retail real estate lending, you know. Fast forward to 2008, and I was thinking like, what on earth was I thinking? You know, that's like a flashing red light. Borrow 125% of the value of your home. Bad credit, okay. By the way, the lender ultimately was General Motors Acceptance Corporation. And that decision wasn't very good for an auto company either.
Yeah, and and you look back on that too. Why were they even involved in that? Like, how does something evolve to that where they're offering 125% loan to value on people's properties?
But I guess it's a credit spread. You know, I guess they were able to borrow short at fairly low rates and lend long at better rates and try to live on the spread until the spread went negative. And then, then when it went negative in a big way. You know, I've been a community bank investor for a very long time, and I'm very attracted to the banking business per se. It's a wonderful business, provided that you don't get stupid, provided that you don't lend long and borrow short, provided that you lend against collateral that you actually understand. Where bankers go way wrong, and I'm sure that you experienced this in your career as a retail banker, is that bankers take basically pretty good businesses and they wreck them by being greedy, by being over leveraged, by pretending that they can underwrite in 1,000 different industries when they can at best understand two or three. The idea right now that you can borrow money from depositors, federally guaranteed, at 4.2, 4.3, 4.4%, and put that money out at prime, uh, you know, enjoying a 375 basis point spread. And you can do it at 12 to 1 leverage, which the Fed considers conservative, tells you it's a really good business if you don't screw it up. The problem is the temptation is there. Sometimes even the incentives are there to screw it up. And I would suggest that's the difficulty.
Well, and we saw after 2008, and even with Silicon Valley Bank, that there's no accountability for it, right? So how big is the risk?
Well, I don't know that that's going to repeat itself. The victims in Silicon Valley Bank were extremely powerful politically. They had been extremely generous donors, and generous donors to the party then in power. I don't think that you will see that type of congressional generosity occur in the event of another bank failure. I may be wrong, but you'll notice that Silicon Valley Bank didn't have a lot of $250,000 depositors. They had a lot of eight and $900 million depositors, and those were extremely connected depositors.
How do you has your approach or perception of community banks changed at all since 2008 to where it's at
Not at
today?
all. I mean, you know, in the banks that I was invested in 2008 were old-fashioned banks. They had money in them, and they did extremely well in the aftermath of 2008. The great big banks and the go-go banks didn't have any money to lend, which meant that the banks I had invested in, First National Bank of Alaska, Farmers and Merchants Bank of Long Beach, these boring institutions with, you know, 20% of total assets being represented by equity, did extraordinarily well, expanding their market share for 18 months at the expense of over-leveraged competitors. So for me, 2009, 2010 were absolutely glory years in banking investment. And we have the same circumstance now. We have a banking community that is way long commercial real estate because it worked for 40 years. And we have a banking community that is still uh, borrowing short and lending long. Uh, we still have a banking community like Bank of America, as an example, that if you mark their loan book to market, would be upside down. They are allowed to call those loans held to maturity, so they're not forced to mark them to market. But if you have a average duration of 9 years, which you're funding on overnight deposits, and the interest rate goes up, the net present value of that revenue stream goes down as the interest rate goes up. This is a circumstance where if we do have a credit problem, particularly in commercial real estate, there's going to be tremendous opportunities for well-run, solvent community banks. The same guys that made a fortune in 2009 and 2010 will make a fortune in 2025 or 2026 if we have the set of circumstances that both you and I worry about.
Well, and that's going to be my next question in regards to commercial real estate because, Rick, I don't even I see shopping centers that are empty on the retail front. I see office parks that have plenty of vacancy, and yet they're still building here in Phoenix. It's unbelievable.
I was in New York City about 5 months ago, and there was a second tier office building, but in a very, very, very good part of town, Midtown. And that office building was 11% occupied. That doesn't pay the occupant, that doesn't pay the operating costs of the property, never mind the mortgage. Um, I think there is a lot of sin in the commercial real estate market, extend and pretend. And there's still a lot of sin probably in good markets in construction lending because it's worked for 40 years, because it's paid loan bonuses, because as you say, everybody's making money except the final bag holder. Uh, I don't know. I think it's a very, very, very good time to be a prudent banker.
Are you surprised that it's been able to hold up as long as it has?
Things like that don't surprise me anymore. When I was a young man, I would think if this is true and this is true and this is true and this is true and this is true, and this is the conclusion. What happened to me was I confused two words in English: inevitable, meaning it had to happen, and imminent, which meant it had to happen soon. And I've learned that even things that absolutely positively have to happen don't have to happen in the time frame that I think is appropriate for them to happen. Both good things and bad things. So I've sort of given up on timing. I realize that most people want a time certain, just like most kids want the tooth fairy. But wanting something that you can't have causes unnecessary stress. So I have really, from a practical point of view, not much of a sense of when the good things that I think are going to play out are going to play out, and when the bad things that I'm afraid are going to play out are going to play out. And I try to live my life to deal with that uncertainty as to timing. I'll tell you this, though, Michael. I've learned as an investor that if I ask myself an investment question where the answer absolutely positively begins with when, as opposed to one where where the answer begins with if, those when questions are much higher quality questions than if questions. And focusing my portfolio on questions where the answer begins with when, not knowing the timing, as opposed to if, something that might happen or might not happen, has been very good for me since I adopted that sort of stratagem, which was about 25 years ago. I really, truly prefer questions where the answer begins with when, not if.
Can you share with me a scenario of that?
Sure. Uh, One example would be we have in the United States at the federal level net present value of over $100 trillion in unfunded federal promises. Medicare, Medicaid, Social Security, military trust fund, environmental trust fund, federal workers pension, $100 trillion in net present value of unfunded liabilities. It's probably politically unpalatable to stiff those intended beneficiaries. Now, if you take that $100 trillion and you add that to the net on balance sheet liabilities of the US government, $29 trillion, it means that we're $130 trillion behind the eight ball when the IRS estimates that the private net worth of Americans is only $141 trillion. So if you can't honestly default on the debt, it seems to me you have to dishonestly default on the debt. You dishonestly default on the debt by printing and inflating away the purchasing power of the US dollar. In other words, you tell some old codger on Social Security, say Rick Rule, yep, we promised you $4,000 a month and we're going to give you $4,000 a month. But your $4,000 is going to buy you $600 or $700 worth of goods and services 10 years from now. We did this in the decade of the 1970s. In the 1970s, according to the Office of Management and Budget, the purchasing power of the US dollar declined by 75%. I think that's a when circumstance, not an if circumstance. Is this realization going to come to the market in 2025 or 2026? Or is it going to come to the market in 2030? I don't know. But I think it's a when question, not an if question. And it's an important question. If I'm right about reducing the purchasing power of the US dollar by 75%, that impacts my decision about whether to own gold. In the decade of the 1970s, at the same time that the purchasing power of the US dollar declined by 75%, the gold price went up 30-fold. Now, I'm not saying the gold price is going to go up 30-fold, but I think decreasing purchasing power of the US dollar is a when question, not an if question. I think it's ordained by arithmetic. And the consequence of that is that I think it's much more likely than not that at least the nominal price of gold goes up. I think that's a when, not an if, but I can't tell you when.
Is it a win question in debating gold or silver or splitting it up?
My experience is, and this is anecdotal, not statistical. My experience is that three times in my investing life, we've had good momentum in the gold market. And in each of those three occasions, when the generalist investor came down into the precious metals space, uh, once the direction of the market had been established by gold, silver outpaced gold. It takes gold, it takes the fear buyer to kick off a precious metals market. But when the generalist comes down into the space, perhaps it's because of silver's lower unit cost. I don't know. But at some point in time in a precious metals bull market, leadership shifts to silver and not to gold.
Where,
Uh,
oh, good.
no, that's fine.
Oh, where do you think we're at right now then in terms of the precious metals? I mean, obviously, gold, the price of gold has been going up.
Yeah,
Silver's been,
we're in a precious metals market. We're not in one that's seeing a lot of generalist buyers. The only generalist buyer that we've seen, they're big ones, are non-U.S. central banks, but they've been big ones. I personally believe that this will be a pretty strong precious metals market because this is the first time in my lifetime that the world's reserve currency, the US dollar, has had challenges of this order of magnitude.
yeah, well, and also right now with the tariff war that we're seeing, and you talked about this, tariffs or taxes.
Yep.
What is he attempting to accomplish by this?
Trump,
And go
Trump
ahead.
is transactional. I don't think he cares about the greater good at all. I'm one of those few people. By the way, I don't like Trump particularly less than I liked his predecessors. That would be a very low bar, of course. But I did read his book, The Art of the Deal, and I learned that he believes that most transactions don't have two winners; they only have one. I believe differently. I believe that transactions should have two winners. And he believes that he should make his opponent's life as miserable as he possibly can so that they capitulate to him. I know from observation that tariffs are taxes. And I believe colloquially, taxes suck. The idea that Canadians, as an example, are going to pay the price of the tariffs is stupid. US consumers are going to pay the price of taxes. I also know that Mr. Trump is an aggregator of power, like all politicians. And there is nothing that gives him the ability to bestow favors and be transactional, like picking and choosing tariffs, rewarding his allies and punishing his enemies. I mean, I get that.
And I haven't even looked before we started recording because Canada, Mexico, China. Those are the three countries that are in at some point the EU. Those are the that's who's in his radar right now for this.
I suspect, but other things that are drawn to his attention that will either give him the ability to reward his friends or punish his enemies, or countries that he can punish where that punishment resonates with his base, which is to say, increases his popularity with his base. I think that you'll see, as long as he can get away with it, revolving punching bags. That's what politicians do.
Explain that to me. Revolving punching bag in terms of tariff or credit.
To the extent that it became worth his while politically to punish India or Singapore or somewhere else, to the extent that punishing them would resonate with his voter base, or to the extent that he could benefit some power group in the United States, some industry, some union, politically, I don't think he'd hesitate to do it.
And the people that are so loyal to him, they are so blinded by the fact that they're obsessed with him and he can do no wrong. It's the weirdest thing to me, Rick.
Yeah, I guess people identify with politicians the way they identify with football teams. One of the few bad habits I don't have.
This episode is brought to you by Vaulted, launched by McIlvaney Financial Group. The simplest and most affordable way to own physical gold and silver. Physical gold is the only asset outside of the control of the government and banking system. They can print dollars, but they can't print gold. Click on the promo link in the show notes or go to vaulted.blbvux.net/coffeeandamike. So one of the other things that I heard you say in one of your interviews, and I'm paraphrasing here, but in regards to gold, you bought gold because not fear it could go from 3 to 9,000
Yeah,
potentially.
the quote was, somebody asked me at $2,700 gold what my price target was. And I said, I'm too old to have a price target. But I don't own it because I think it might go through 3,000. I own it because I'm afraid it's going to go to 9 or 10,000. I own it because I believe over the next 10 years that the purchasing power of the US dollar will decline by 75%. And at least the nominal price of gold will go up by at least a commensurate amount. So it isn't so much that I care about short-term trading profits in gold. I don't, because my gold's not for sale. What I'm interested in is maintaining my purchasing power over a decade. If I'm right, and if the purchasing power of the US dollar declines by 75%, it makes perfect sense that the gold price would triple or quadruple, at least in nominal terms. It would maintain its purchasing power. When people who haven't been around the gold market much ask me, or even some that have, they say, Rick, when do you think the gold price is going to move? And I scratch my chin sagely, and I say, I think it's going to move in the year 2000. In the year 2000, it was 250 bucks an ounce. Now it's 2,900 bucks an ounce. So it's up sevenfold. It's up 8 and change compounded every year for 25 years. So yes, I think the price of gold is going to move. I think it's going to move in the year 2000. It's really difficult to argue with arithmetic.
Well, and average consumers don't. Not to say that I have a full grasp of this, but I'm fortunate enough because I get to talk to people like yourself and others. That gives me a little bit of an insight on where things are. But average people, consumers that work 8 to 5 jobs, put money in their 401k, I don't think they understand what's really coming.
Sadly, I would agree with that. One of the reasons in my declining years I'm so active is I'd really like to draw people's attention to bigger issues. I'd like to drive the average American taxpayer's attention to debt and deficits. I'd like to tell particularly the younger taxpayers who believe that there's going to be Social Security and Medicare and Medicaid for them, that they need to make other plans. Uh, and I absolutely agree with you. We've lived through 40 very benign years in the period 1982 to 2022. We're going to survive the next 10 years, but it's going to be a lot less benign than it was. And people who have a belief that life is going to go on the way it's gone on for the next 40 years probably need to make some other arrangements. Uh, People hate it, but let's get back to arithmetic. We discussed before the net present value of government obligations is $130 trillion. The IRS estimate of the private net worth of American citizens is $141 trillion. There's only an $11 trillion premium before state and local debt between what we owe and what we have. Now, I understand there's a timing gap. We're liquid, but we're not solvent. But it gets worse. The on-balance sheet liabilities of the U.S. government increased by $2 trillion a year. And the off-balance sheet liabilities, which is to say Medicare, Medicaid, military pensions, that kind of stuff, increases by another $2 trillion a year. So every year, we get $4 trillion further behind the eight ball. Now, gross federal revenues before the U.S. government spends a dime are $5 trillion. Every year, we get $4 trillion behind the eight ball, while gross federal revenues are $5 trillion a year. And people don't think about this. Somebody's been getting a paycheck for 20 years. They're 45 or 46, and they think, well, I got to save enough so that when I get to Social Security, my savings will supplement Social Security. Understand, with Social Security, you're an unsecured creditor behind $130 trillion in other claims.
It's
This is just math, okay? You're going to get a lot of hate mail from guys saying, I paid into my Social Security, I deserve it. So what if you deserve it? I agree with you that you deserve it. Just like we talked about owl bonds earlier, owl checks. From who? From who? It's important that people pay attention to this arithmetic.
Well, that's one of my biggest concerns is, what are people going to do when they realize, we didn't talk about this yet, but, are you under the belief that, say, 10, 15 years from now, the pensions that they've been paying into, like some of these 401ks, that money is not going to be there?
Well, in your 401k, you control it. Whether or not it's there is up to you. I would urge people to pay attention to what there is in their 401ks. Just like I would encourage Ma's and Pa's who want higher yield but don't understand they're taking credit risk to learn something about the assets that their money managers are owning. People ask me, Rick, do you think NVIDIA is going to go up or down? And I say, yeah, I think it's going to go up or down. That's what I think it's going to do. And they said, well, don't you have a more specific answer than that? I said, no, I don't understand anything about NVIDIA. I can't even spell what they do for a living, and I don't know what NVIDIA is. So it's not in my portfolio. Well, how can you ignore it when it went up so much? And I said, because I can ignore it now when it went down so much. It doesn't matter. People need to take control of their financial future themselves.
Do you know how many people I meet, Rick, that are in the Bitcoin market right now, and they like it because it's exciting, and they feel like gold is boring? You've probably
Yeah,
heard that a million times.
sure. I mean, good for them. When it comes to my finances, Michael, boring is high praise indeed. I think boring might be regarded as the antidote to terror. And I would prefer to be bored than terrified personally, particularly where my retirement's concerned.
What are your thoughts on the administration and the recent crypto summit?
We have a country that's $130 trillion upside down. And these guys want to take some of the money that we don't have and invest it in an asset class that they don't understand. Mr. Trump is talking about a sovereign wealth fund. What wealth? For me, assuming that he can afford to put a couple $1 billion into crypto or whatever it is he wants to do with it, he could either use that money to pay down the federal debt or he could give the money back to its owners, the taxpayers. I would like to make my own investment decisions.
But people still want to be told what to do, Rick, and that's the problem with this country. And you've seen the pendulum now go from the left back to the right, but
Right.
there's a theme. People want to be told what to do.
And I'm afraid, as a good speculator, a good investor, and a good lender, uh, that those people will continue to increase my private wealth. The people who do well are the people who take control of their financial future. The people who don't take control of their financial future, unfortunately, I think, to quote H.L. Mencken, the voters almost always get what they want, often good and hard. Uh, I guess that's the thought that I would leave with people who want to consign their financial future, and their personal liberties to others.
Last question, and I'm running out of time here with you. What is the state of Europe in comparison to what we just discussed here in America?
They're in worse shape than us, with one exception. Their on-balance sheet liabilities, not their off-balance sheet liabilities. Their off-balance sheet liabilities are higher, but their on-balance sheet liabilities are lower because they're such lousy credit risks that people haven't been as willing to lend them money. The deterioration of personal liberty, and the deterioration of the private purse relative to the public purse has gone on in Europe longer than it has in the United States. Um, so standards of living, individual standards of living in Europe, are much lower than they are in the United States. Now, America is a very competitive culture, and we try to win every race we enter, even the race to the bottom. So we're, the pace of American deterioration is probably picking up even relative to Europe, but they're a long ways ahead.
Do you see a potential there for some type of civil unrest or conflict?
Yeah, but I'm not alarmist in that regard. I lived through the decade of the 70s, the late 60s, early 70s, when there was civil unrest even in this country. And Paris was, 1968, Paris was burning. I mean, I remember that. So there's probably, I think there's a probability of civil unrest, and I think we'll get through it. I think we'll get through this challenge too. I just think that the next 10 years will be different than the last 40 years.
What are
In our country in particular, we still have enough vestiges of the creative, determined society that made us what we are. We're still a place where 5 or 6 young kids can commandeer a garage in Sunnyvale, California, and out pops Google or out pops Apple, which is a long way of saying we're still a place where our individual tenacity, our individual brilliance has funded our collective stupidity. And I think that'll continue to be the case. It just won't be as easy.
That was going to be my last question is, over the next 10 years, what do you envision then for regular people? What life might be like?
Well, I think regular people are going to learn, just like they learned in the decade of the 70s, to be a little more cautious, to learn that not every outcome is rosy, to learn that you have to save, to learn that immediate gratification are two different disjointed words in a dictionary, not a way to live your life. And I think we'll learn that. I just think it's going to be a challenge. I think people are listening to podcasts like your own, are preparing themselves for that future. And I wish more people would do it. Uh, Unfortunately, those people who don't prepare, who are probably in the majority, will enjoy the same deterioration in their standard of living that Americans enjoyed, if that's the right phrase, in the period 1970 to 1980. For those of you who weren't there, we got through it, and it wasn't pretty.
So what do you tell people, Rick? They come to you and they say, Rick, I'm lost. What should I do? What's the first thing you say?
Uh, Spend less than you make, invest before you speculate, stay a little bit liquid, even if it costs you money, and be applied, be focused. Don't invest in things you don't understand. really boring stuff. I think most people don't actually want to be rich. I think they want to live rich. And I don't think that that's a viable option in the next 10 years.
Because of they want the facade, right? They want the nice car at 25 years old, and they want the
The last 40 years have been very benign. The period 1982 to 2022, right? Falling real interest rates, U.S. hegemony, so we could export our inflation. That's over. So you got to get used to that. Every really, really, really good party usually comes with a bit of a hangover. So we're heading into the hangover phase.
Are you staying? All right, lad. One more question. Are you staying away from the whole AI? You know,
Yeah,
yeah.
I don't understand it. I do things I understand. I do things where I can understand the calculus. I intend to be a beneficiary of AI. I mean, I can see how you could employ big data searches in mineral exploration, and you could see coincident anomalies spread over a lot of data in a way that would make exploration more efficient. I'll benefit from that by confining my speculation to that form of AI, which is to say mineral exploration speculation, where I'm competitive. I'm not going to pay attention to the top level technology because that assumes that I'm as smart as those 22 and 23-year-olds in Sunnyvale, California, which is a horrible assumption.
Where can people find you, Rick?
I'll give them an incentive. People, natural resource investors, who, in particular, who like my advice and want to personalize it, should go to my website, ruleinvestmentmedia.com. List your natural resource stocks, and for free, no obligation, I'll personally rank them 1 to 10, 1 being best, 10 being worst. Please no crypto, please no pot stocks, please no tech stocks, just natural resource stocks. Um, Love to do it. For people who are interested in what I have to say about banking, and in particular for those of you who are uncomfortable with your current bank, try my bank, Battle Bank. Go to battlebank.com. Old-fashioned bank with money in it. Uh, a bank that pays you interest on your checking. If you're interested in interest, check out Battle Bank. Or when you go to Rule Investment Media in the question and comments section, just write in Battle Bank and we'll send you the information.
Also, social media. People want to find you.
I'm sorry?
Social media. If people want to find
Yeah,
you.
I forget my handles. I guess X, I'm Real Rick Rule, at Real Rick Rule, something like that. I'm easy to find. I'm noisy.
Uh, um, Rick, I appreciate you doing this, and I look forward to continuing to follow your work and hopefully more conversations ahead.
I look forward to that too. Thank you for the opportunity to talk to your audience.
Mic drop.